Welcome to this custom deep dive for the Modern Investor series from the Royal Krakow Mint, the precious metals show. It's March 2026,
Yeah,
and geopolitical tensions are redlining, inflation's creeping up again, oil is surging.
right. Exactly the setup you'd expect for gold.
Right. Historically, this is exactly when gold puts on its cape, but instead it just plummeted, like 15%.
Yeah, it really did.
So our mission today is to figure out if gold's safe haven status is actually dead. Because honestly, it's like packing an umbrella for a guaranteed downpour only to have it suddenly melt in your hands.
Or, finding out the umbrella was actually made of sugar.
Exactly.
What's fascinating here is that the panic wasn't because gold fundamentally broke. The environment around it just shifted dramatically. The invisible force pulling it down was, well, high interest rates.
Wait, but if the world is panicking, why do interest rates suddenly matter more to you than physical safety?
Well, because money always looks for a yield.
Right.
Gold pays you 0% interest just to hold it.
Oh, sure, because it's just sitting in a vault.
Exactly. When rates are high, you can park your money in government bonds or cash and get a guaranteed return. And right now, the specific type of inflation we're seeing is driven by energy.
Oil prices, yeah.
Yeah, oil and energy. And that absolutely terrifies central banks.
Okay, let's unpack this. So instead of cutting rates to stimulate the economy, central banks are forced to keep rates high to crush that energy inflation.
Precisely. And those high rates make zero-yield gold look, well, a lot less attractive. Plus, remember, gold had a massive run-up leading into 2026.
Oh, right. It was already up significantly.
Yeah, so when the crisis actually hit, people didn't buy more gold. They actually sold it.
See, that doesn't make sense to me. If the rest of my portfolio is bleeding because the market is crashing, why would I sell the one asset that actually went up? I mean, shouldn't I dump the losers?
You'd think so, but in a crisis, you need immediate liquidity.
You just need cash.
Right? You need cash to cover margin calls or offset those massive losses elsewhere. You can't sell what nobody wants to buy, so you are forced to sell your winners.
Wow.
So gold essentially became a quick ATM for investors who were just taking profits.
So if gold is just being used as a cash machine the second things get rough, investors must be looking for a new set of rules, right? To figure out when to actually trust it.
Yeah, the definition is definitely evolving. We're looking at a new reality that's dictated much more by macro policy than just the shock of a crisis itself.
Right.
There's essentially a new formula now. A crisis paired with falling interest rates means strong gold.
Okay.
But a crisis paired with rising interest rates, like we
Mm.
saw in March 2026, results in mixed or even negative performance.
Okay. So it's no longer this magic, impenetrable shield. It's more like a financial thermostat.
I like that.
Like it only kicks on to protect you if the house's interest rate wiring is set up correctly.
That's a great way to put it. And right now, central banks have their hands glued to that dial.
But wait, here's where it gets really interesting.
Yeah.
If everyday investors are treating gold so conditionally, dumping it when rates tick up, what are the big institutions doing?
Oh, they are hoarding it.
Really?
Yeah, central banks are on track to buy roughly 850 tons of gold in 2026.
Wow. 850 tons.
Exactly. And it's not just the traditional heavyweights anymore. Entirely new countries are aggressively entering the market.
So they aren't treating it like a short-term ATM at all.
Not at all. They aren't looking for a quarterly yield. They are hedging against systemic currency risks and massive geopolitical uncertainty. Their confidence is honestly completely unwavering.
So if the biggest financial players in the world are aggressively hoarding physical gold as this strategic long-term asset, shouldn't we be completely ignoring this short-term retail noise?
For you, the modern investor listening, that is absolutely the crucial takeaway. You have to separate the signal from the noise here. Gold is a portfolio stabilizer. It's not a short-term day trade. When you see massive volatility, it doesn't invalidate gold's worth.
It just tests your conviction.
Exactly. It remains a safe haven, but a highly conditional one if you're only looking at the short-term liquidity environment. Institutions are looking decades ahead.
Right. They're preparing for foundational shifts while the retail market is reacting to, like, a monthly jobs report.
Exactly.
So what does this all mean for you? If central banks are quietly securing massive gold reserves while everyday investors panic sell over interest rate volatility, who will ultimately be holding the leverage when the next unforeseen systemic shock hits?
It's a great question.
Something to really think about the next time you reach for your financial umbrella. It hasn't melted, it's just built for a completely different kind of storm. Thank you so much for joining us on this deep dive. Keep questioning the consensus, and we'll catch you next time.